So have a great interview with him, Dale.
David and I had a bromance before you cut in, man.
What?
Right?
What?
Hey, David, welcome back, buddy.
I don't want to jump into this conversation. It's such a feel-good right now. I'm just kind of sitting back and enjoying it. Thank you.
Yeah. So look, everyone loves you. What can you say? It's hard to handle all that adulation. I know.
And on top of it, Dave, you're really, really good technician too. Yeah. God, just the cherry on top. Anyway, you guys have a great one. I will not interrupt this bromance right now. See you guys.
All right. See you, Blake. See you, team. Thank you very much, everyone. So Dave, I haven't talked to you for a while, and we've had some pretty massive action and recoveries here in the last week or two, and I'm interested in some of your views on, was this just another garden variety correction, maybe a little bit more in MegaCap Growth, but all last year we had those 5% corrections, and they all held, and we're at new highs in short order. Look the same to you now?
It's so funny. I mean, I feel like 2021, when you look at a chart of the S&P 500, it looks at the surface level like the easiest year in the history of investing, right? It was a pretty straightforward, approach. The markets overall were consistently making new highs. The S&P pulled back to its 50-day moving average 10 to 12 times last year, and in all but one of those had a very tradable bounce right after. I mean, literally, if you just bought every time the S&P touched its 50-day, you had a pretty decent strategy for performing well last year. And so here we are once again, making new all-time highs to 4,800 into year end, pulling back to the 50-day. And I think the question for a lot of investors is this just yet another sort of tradable pullback, sort of an actionable pullback to support, and so far it's playing out that way.
Yeah. So when we were there Monday, and there was carnage, and I would say that NASDAQ looks a little different, but don't we have a bunch of different? I mean, you really have to be sector aware now, Dave. I mean, I think the transports before we had the sell-off looked like they were finally on the verge of doing something pretty good to the upside. And that was unusual. That was in you interview Michelle Schneider, and she showed the transports almost at a breakout level. Did that happen this week with this recovery? Kind of a triangle.
You mentioned being sector aware, which is such a great way to think about it.
It's like, and that's the truth. 20 different markets out there now. You can't just say the market.
And what I was thinking about last year is, even though the top level index is look incredibly orderly, if you look underneath the hood, last year was violent in a lot of ways. Blake was just talking about having a little position feeler position, and someone in the chat said, it's the pain, it's feeling the pain. And one of the quotes I learned early on in my academic career was, suffering is the origin of consciousness. And I feel like all investors suffered in some ways last year, but it helped kind of wake you up to the reality of this sort of rotational environment. There are periods where growth or value or pure defense, like REITs or utilities, all had a chance to,
consumer staples for a while.
Consumer staples, a bunch of them making new highs not too long ago. And so it's been everything has taken a seat, or taking a spot in the driver's seat. And so you absolutely, I think, looking at just the top level indexes, looking at just the futures, you're getting a very small piece of it. There's a lot of activity underneath, particularly cyclicals, things like energy and financials that have done very, very well. And when those stocks do well and growth stocks are struggling, the indexes are held back a little bit just because of the weight in some of those growthy sectors.
Yeah, that concentration of those 5 or 7 stocks. The dollar took a little hit, and I don't know if you're looking overseas, but Europe's been outperforming the U.S. the last 3 months. The last 3 years, the U.S. blew it away. But if there's a change of regime in the dollar, will more U.S. investors start looking abroad because of that impact of a weaker dollar?
So there's a couple really interesting themes to pay attention to. The dollar is absolutely one of those. And then sort of that, if you look at the last 2 years on the dollar index, 2020 was a year of a weaker dollar. 2021, the year of a stronger dollar. And so far in the very early days of 2022, you're starting to get this reversion down. Really, the weakening started back in November, right? When the index started rolling over, when the dollar started rolling over. And I think US-based investors have very appropriately so gotten very comfortable with a stronger dollar, which means there's very little reason to be looking outside the US as an allocator, just because of the strengthening dollar. There's just not a lot to be had there. But if we do get a dollar that's struggling a little bit, you do get a rally in the euro, which is what we're seeing here. All of a sudden, some non-US markets start to look a lot more attractive, and the weaker dollar is certainly a tailwind to non-US outperformance. So I absolutely think for me and other investors, you haven't really looked overseas that much because it hasn't been a great opportunity, just given this chart rotating. I think it really is. And I think you need to be opportunistic at the beginning and sort of look where there are pockets of performance, but certainly could be a different feel this year than what we saw last year.
Yeah. And, that's happening. When we had that big break a few weeks ago, one of the most interesting parts of it was there was nowhere to hide. There was no flight to quality in TLT and bonds, the metals that were going lower. It reminded me of everyone saying cash is trash, and that was the only thing that worked for about a week. There was nowhere to hide, and we had some pretty good 3% sell-offs, and the bonds really couldn't get off the mat. So what do you think of the TLT? I pull up the weekly all the time, and it looks ominous to me.
No, it does, and I think if there's one of the key themes, a weaker dollar, potential weaker dollar, I think is one important one to pay attention to. Higher rates and just the reality of higher rates is going to be an important one. I think a lot of people have gotten used to this idea that rates could go higher, and that bond prices come lower, but the reality of that could be very different, just because we haven't really seen a big bond sell-off, and a big rise in rates. For quite some time. You saw it in the second half of 2020, but in terms of a larger sort of market trend, I think the 10-year yield going higher, TLT coming off, is certainly a likely occurrence this year. And again, we just haven't been through this sort of a Fed activity that we're expecting in 2022 and 23. One of the charts behind me in my office, I have two big, charts on my wall, and the one is the U.S. interest rates back to 1910 or 1915, if I remember, and it's sort of this big upward trend in rates on the left half of the chart up until around 1980, and then this big downward trend in rates. And even though the bonds prices have come down, even though the TNX has gone up, that's the 10-year yield index. If you look at the last year or two, it feels like rates are pretty high. And when we're getting to 170, 180, it feels excessive. But all you need to do is bring in a little more to history just to see how low rates still are relative to where they've been. And, I was told early on, never confuse the top of the page with resistance. So just because something's gone up a lot doesn't mean it can't continue much further. I don't know if we see the 10-year up at 320 again, which is where we were at the end of 2018, but certainly getting above 2%, absolutely. Getting to 2.25 and even more, totally reasonable in 2022. And I think that environment where you broadly see value-oriented sectors like financials outperforming growthy sectors like technology, I think that's something a lot of investors have not really seen, and I think would surprise a lot of people.
Yeah, so the people are definitely still. I was hearing things like Amazon's flight to quality stock, and all the crypto people, when they sold, would park in Amazon and Apple, and even on this recovery, Apple doesn't seem to have the same juice it did before. So tell us what you're seeing in say FANG or NASDAQ 100.
Yeah, I mean, so the reality is, and when you look at some of these charts like Amazon, the question I would ask is, justify owning this stock over the last year from a technical perspective. I don't think you can do it. If anyone I've asked, tell me give me the investable thesis for Amazon last year. It's a long-term thesis. It's fundamental, and it's why Amazon is a great long-term grower, which is right. If you look at, 10 years of history, clearly it's been able to do that. But if you look in recent history, it's been a horrible name to own. I mean, we're literally at the same level now that we were in July of 2020. And imagine that as the S&P and the NASDAQ have made consistent new highs over most of that period, you have a stock that's gone nowhere. And this is obviously a huge weight in the broader markets, but particularly in consumer discretionary, right? In the XLY, it's one of the three big names along with Tesla and Home Depot. And so you have a stock that's been a chronic underperformer. So plenty of times when Amazon could have been an interesting place to rotate, but you just haven't seen it materialize on there. So I think this is a great reminder for investors to not think about what should happen or what could happen. Amazon will probably do well because of XYZ, and focus on the evidence, which is the fact that this is at the lower end of a range that's been going on for almost 18 months now.
And Microsoft was one of the monsters that carried the rally last year. And I'm interested in seeing what type of recovery we have. I mean, is this just a correction and we're on our way to 350, or should I look to be a seller around that moving average around 330 and see if we could get down to the 200-day moving average you have?
Yeah, and you can see how I always talk about charts and describe what I call a change of character, right? When the chart looks a particular way, and then all of a sudden it starts to look different. And if you look through much of this chart, really starting at the market, low in 2020, from there, after a little sideways period, and when the market was sort of choppy in the fall of 2020, overall, this has just been a nice, consistent uptrend, right?
The
nice
50 worked there pretty well too, Dave, for the last 2 years.
Oh yeah, and just consistent, strong relative performance. I mean, it's just been a really good name to own. But if you look at the last couple of months, you can see how things have changed, right? This is a stock that stalled out, and you had this big sort of bearish candle pattern, a bearish engulfing pattern there in late November, which ended up being a pretty great indication of excessive bullishness and really stalled out price trend. And from there, it's hit 340 a number of times and it's come right back down. And if you think about what's happened with something like the XLE over that period, you can see where there's been a rotation. So as 2022 is starting, you're seeing this rotation out of, and a trend that had been going on at times toward the end of last year, but really sort of going back on, sort of like the bets are getting put back on the table, long energy, long financials, and really out of things like Microsoft and Amazon and others. And the charts are reflecting that. So your question, what do you do with this? I mean, overall, as a long-term core position, something like Microsoft makes a ton of sense because it's been a nice, consistent performer. As a tactical play, looking at it, I see a lot to not like on something like Microsoft, and I'm seeing better opportunities in other sectors.
Okay, so everyone loves energy right now. Looks a little bit overdone, but probably a buy breaks. I mean, the energy charts that you pulled up, David, it doesn't even reflect that break we had in WTI from 86 to 62.
Right.
Crude WTI has not made new highs, so it's probably a bullish sign that the shares are making new highs and WTI hasn't yet.
That's the argument, right? Because oil prices, they continue, they start to catch up, and all of a sudden there's a lot of upside potential in some of these names. You picked up on a good point, Dale, which is, a number of these, we're looking at Chevron here, overbought. And so right now you have a number of energy stocks that are overbought. They just had a really good run. Now that's happened a couple times before. Look in the last year. The last time was in October, and it really just kept on going, right? Overbought doesn't mean you come down. It just means you've gone up a lot. But if you look back in like March of last year, November of 2020, it was after a big spike higher and you cooled off a little bit. And then you wait to see when it resolves back to the upside. And I think you could see a bit of a mean reversion away from some of the energy names, because clearly a lot of people have gone into them. You could see sort of a mean reversion of sorts with some energy stocks pulling back and some of the growth stuff bouncing a little bit, like the Microsoft chart bouncing up to resistance. But then I think those themes that you're seeing so far year to date are longer themes that are not just short things. I think these are things we'll be dealing with through the course of the year, probably.
So probably looking for failing rally and in some of the FANG names, and a lot of people gravitating to a group that's been underperforming even the underlying commodity for a long time, the miners, the gold and silver shares, and they had a heartbeat with what happened to the dollar yesterday. I'm curious what your work is saying about what's going on here.
It's interesting when you look at the chart of gold. I mean, if there's one kind of question mark or one surprising thing from last year, is that gold really hasn't served as a safe haven at times when you might expect it to do so. Sort of the classic narrative is, gold should come in, particularly if inflation is a huge deal. That's sort of a layup play that you see higher gold prices. And it really didn't materialize. If you told me last year we would be dealing with inflation at the levels that we are, the whole thing where it was transitory until we all realized it wasn't, that should be an obvious gold rally in my head. I mean, if I'm thinking of the playbook, right? And it really didn't materialize.
No, disappointed people. Yeah.
Yeah. Right. So I think it really did. And so when you look at gold, it's very much range bound. And the GLD we're looking at here, it's sort of in the 170, 172 range. That's that pink shaded area. Look how many times it just consistently bounced off that. The one time it actually went above there was in November and it stalled. This is called an island reversal pattern, which is where you have a gap higher, you have a little bit of choppy sideways action, and then a gap back lower. And that's a classic reversal signal telling you that just the buying power that you expected on the breakout never really materialized, and you never saw the follow through. So I think the chart of gold has a lot to prove before it's a longer opportunity. But you're seeing it set up a little bit, and I think a break above 172 and holding that is what's super important on the chart here.
Yeah, I think what held it back was dollar strength. So we'll see if the worm is really turning. I think gold's going to be more about currency debasement than inflation numbers.
That's exactly right. And I think the difference here, what you saw last year was sort of that stronger dollar play, weaker euro. That flips over and you see weaker dollar, which I think we do. You see stronger euro, which I think we do. I think stronger gold all of a sudden makes a lot more sense. So I think, there are reasons why this chart should go up. But again, I've always learned, don't buy the reasons why it should go up. Buy when it actually demonstrates its ability to do that. And I think we're maybe setting up for that. That's what I'm watching, though.
Okay, David, China said they're not going to sell us fertilizer, and a lot of people gravitating towards agricultural markets. The grains look like they're acting good. I mean, almost anything that grows is much higher in prices. People, going into DBA and ETFs like that. Any stocks in the agricultural area that look promising?
No, it's a really good place. And it's funny that materials as a sector really hasn't been that great of a place. I mean, for quite some time, right? I mean, if you look at just if you look at the XLB, it's just not been a fantastic relative performance. It's a pretty small market cap in for the S&P. However, if you look at the setup in materials, it's actually not bad on an absolute basis. And the relative strength is just starting to improve a little bit, which tells me this is the time when you start looking opportunistically for names that are starting to improve a little bit. So when I'm looking at something like the XLB, looking at materials, and I'm screening for stocks that are trying to make new highs, something like CE probably comes to the top of my mind. Which is it's almost like a cup and handle like pattern, but it's really a basing pattern, which is where you've had a big rally and then you sort of are setting up and you're bumping up against resistance a number of times. And this is what's called a basing pattern, which is a multi-month think of it as sort of like building up steam, building up momentum. And if and when you actually get above it, which it's arguably just starting to do right now, it can go much, much higher. And the phrase technicians always say is the broader the base, the higher in space, meaning the longer it's spent time sort of building up this momentum. It's like a coiled spring. And when it finally breaks out, you have this big continued rally. So, names there that came to mind, CE is a good one. What else? Like BHP. I'm trying to think of names that I've screened well in
Rio Tinto and things like that.
Yeah, I mean the miners have been so relatively weak for so long, but just in the last week or two, I would say they've something like BHP was interesting when it's finding support. But when it breaks that interim high, I think that's when it becomes really compelling. And now you're starting to see the rotation higher as well. So miners have not been a great place to be, and I'm certainly seeing some movements there that are encouraging.
So let me go fundamental with you. What do you think the Biden administration would prefer going into the midterms? Headlines being 6-7% inflation, or we've entered a recession, or how about both?
Right. we can see a lot of things before the year is done here, and I think to be honest with you, I think when you look at the presidential cycle, sort of this midterm year, it doesn't tend to be a great year. Next year is where if you look at the normal 4-year cycle, this year tends to be sort of choppier, usually, and it tends to be one of the worst of the 4 years. But the third year, right, the re-election year is when things start to set up pretty well. So coming off of the incredible year that we did last year, the reason is because this is when policy decisions tend to be made that are a little less favorable because you got a little room before in the next year to sort of recover from whatever you're going to do right now. And so I think, when I think of this overall market environment, I think of elevated uncertainty, elevated volatility. I wouldn't be surprised if the VIX spends more time above 20 than below 20, which would be very different than what we saw in 2021, where the VIX is sort of in the 15 to 20 range for a lot of the year and spiked up a couple times. But given all the conditions, and then, the Omicron virus and everything, obviously, which is still a huge unknown in terms of the short-term and long-term impacts, I think there's a lot of uncertainty here. So there are a ton of competing narratives. I think at the end of the day, it's still a very rotational environment. Looking at a chart of Newmont Mining, it's an interesting chart. I don't know if this is going to be a great chart for the next 12 to 18 months. I know in the short term, you're seeing a rotation there, but we've had so many rotations in the last 12 months to deal with. I'm not seeing things that tell me this is a huge, long-term rotation. It's just, these are all tradable moves that you have to be on top of, I feel like.
How do you think the market would react to Putin invasion of Ukraine by the end of the month?
It's an interesting question, only because if that was happening in a vacuum, I think I could tell you some very specific things about what would happen. I don't know if it's going to move the needle a ton, to be honest with you, because I think that sort of plays in the whole geopolitical stability, challenges. Could the market have a short-term effect? Maybe, but I think the fact that we're dealing with the other headwinds, the market headwinds that we are, I think the main things to pay attention to are the interest rate environment, the dollar, coronavirus. I think that would be like a distant fourth compared to those first three, to be honest with you.
Yeah, I think people are sanguine about it because I don't recall what the market did when he went into Crimea and annexed it, if there was any angst in the market or not. I guess that would be, kind of a model that people might go back and look at, see what happened. But
the fact that you and I both don't know the answer to that probably
that it wasn't
a huge one.
Well, I don't know, Dave. My memory's, it's okay. Anyway, so what's the best way for people, Dave? I mean, some great looks, and always enjoy talking to you and getting some clarity. And I really appreciate you coming here and having a giving spirit, sharing your ideas. So the best way for people to follow you is Twitter, and catch your shows on stock charts and your website. There's many ways for people to reach out, right?
Absolutely. Yeah, Dale, it's a pleasure. I'm glad I caught a little bit of Blake Morrow's comments earlier. I thought that was some great market wisdom I was jotting down as we were getting started there. It's a pleasure, and I enjoy coming on anytime you'll have me. Stockcharts.com is our main site, and Stock Charts TV is what Dale mentioned. Dale graciously came on my show last year, and hopefully we can convince you to do it again in 2022 and talk charts for a little bit.
I invited myself on last year, so I'm waiting. I'm waiting. This time I'm not going to be pushed.
There we go.
All right.
It would be a pleasure. And then my website's called Market Misbehavior. I have a YouTube channel and other things where I sort of break down these sort of plays and focus more on how you can develop an investment process using technical analysis, really focused on the equity and ETF markets. So I look forward to engaging with all you guys there. And I'm on Twitter at DKellerCMT.
And Dave is a great host. I mean, he conducts excellent interviews. So he's a good guest, and he's a great host, and he gets some great people. So definitely follow Dave around with his views and people he talks to, and you're going to be more aware of what's going on. And I appreciate you being here, my trading warrior brother. Hope 2022 is your best year ever in all ways.
Thanks so much, Dale. Take care.
All right, buddy. David Keller, and you can find him at DKellerCMT on Twitter. That's going to be a wrap. Alexander's thanking you. Rick is thanking you. People love you, David. So Blake and I are going to have competition, and want to remind everybody, no matter what you're doing in the markets, don't just count your digits and your pips and your shares, count your blessings, and that you could be in this game and play this game and have enough capital to do so, and make sure it's risk capital. So that's a wrap for me. You could join the team in 15 minutes for the morning edge, go over the bias charts. Maybe Greg will make a surprise appearance there. I know he wants to get his message out about what he's seeing. Perhaps Andre will pop in with his harmonic artwork. Anyway, take care, everyone. We'll wrap up the day, wrap up the week tomorrow. I have a new guest that hasn't been on F.A.C.E. Julian will be with us, and hope you guys are with us to enjoy it and learn. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.